Hello, everybody, and welcome to the anti-bubble report. We're going to continue with the last section where I'm going to discuss gold, treasuries, and Bitcoin, bubble or anti-bubble. This complements previous parts of the discussion. I hope you will find them helpful. So let's start with gold, and obviously I think gold has been battered throughout the year. I've been in my book and for a long time I believe that gold is an anti-bubble in the system. Obviously you can't print gold. I believe in gold as a monetary asset of last resort. I see the return of sometimes you worry about the return on your capital, sometimes about the return of your capital. Carry considerations in a world with negative nominal real yields, the asymmetry of gold versus fixed income, all this fallacy of deflation, currency trade wars, investor positioning, volatility correlation, and many others. So I think gold, I know sometimes I might look and feel like a dinosaur, but I think gold has a role to play, and the current sell-off provides an opportunity to accumulate. And I think gold has a meaningful role to play. What we see from a technical perspective, as we speak, as of recording this, you see gold potentially breaking interesting levels that could open the move back to more normal levels, in my opinion, more consistent with the sort of relationship with real yields and inflation and what we're seeing. So big believer in gold, meaningful portion of our strategy, and I think one of the assets that is grossly mispriced. Treasuries is a bit of a different story, and treasuries, I would argue that they are not an anti-bubble, but they're certainly an anti-crisis strategy. And relative to other fixed income assets, such as bonds or others, nominal yields have plenty more risk to go. So yes, there's no such thing as risk-free interest in real terms, but in nominal terms, even the 30-year 180, if you send things to zero, there's still 50% plus upside. So in nominal terms, I think duration in dollars in treasuries has room to play. It will make sense to keep it in the portfolio. We favor tips to nominal treasuries, but nevertheless, I think this is something that will continue, as I mentioned in previous parts. It will continue to support perhaps some risk assets through duration, but ultimately, we think treasuries has a role to play as a defender, and I think this idea that as inflation comes, interest rates go up. It's, as we discussed, not in the previous section, it's not so much because interest rates go up, it's because interest rates don't go up, and it's about outflows from fixed income forcing central banks to intervene, etc. So this chess game is taking us to a point where I think we're in a new paradigm where we will see higher inflation and lower nominal yields and very negative real yields, where basically the treasury could help nicely in nominal terms, less so in real terms, but I still think it has a role to play through duration. We in the strategy have the ability to turn duration to zero or be in other assets. So in that sense, for the time being, we have it, but relative to our position in gold or others is much smaller. And to finish up, I wrote this lengthy article on crypto, Bitcoin bubble or anti-bubble. I'm not going to dwell into it in huge detail. I still think, and I get challenged and a lot. I still think the crypto space is more of a bubble and Ponzi than an anti-bubble. There are obviously lots of merits in the technology and many reasons that I'm supportive of blockchain and many things that will potentially game changers. But I think one of the big criticisms in my view is, or fallacies, is the perception that we've created, what I would call the scarcity fallacy. This idea that there are only 21 million Bitcoins, yet there are 21 million other cryptos you could create out of zero, and it's any other day that you see Shiba Inu, Doge, Ethereum, and whatever you want. The narrative is powerful. Everything's been moved to a whole Web 3.0. But ultimately, a lot of this money is created out of thin air, out of the ether, and I think it's pure wealth effect. And we will see as and when there are potential catalysts. In all fairness, the price action has been simply phenomenal. It took the Chinese kind of prohibition incredibly well, and it's currently at all-time highs. And it's not very wise to short this, but I would be very careful with leverage or longs. And so from our perspective, we're not involved. Well done and good luck to those who are in it. We favor gold, which we think is much more offers more value and better risk-adjusted returns. But ultimately, you know, I think this is a challenging market for many assets, and whether you're playing striker or defender or goalkeeper, you can put Bitcoin whatever you want. I think it's obviously in people's attention, and we must address it. But my overall conclusion is, you know, be careful. With that, I hope the update overall has been helpful. We covered a lot of ground across many areas, and I hope this report is helpful. If anybody's interested on our implementation and ideas, please contact me, and I look forward to your feedback and much success and cooperation. So thank you, everybody. Stay healthy and speak soon. Take care.